This is the Bloomberg Surveillance Podcast. I'm Tom Keene, along with Paul Sweeney. Join us each day for insight from the best in economics, finance, investment, and international relations. You can also watch the show live on YouTube. Visit the Bloomberg Podcast channel on YouTube to see the show weekday mornings from 7 to 10 a.m. Eastern from our global headquarters in New York City. Subscribe to the podcast on Apple, Spotify, or anywhere else you listen, and always on Bloomberg Radio, the Bloomberg Terminal, and the Bloomberg Business app.
NYCB cut to junk by Moody's as stock hits lowest since 1997. The real question for investors, just like it was a year ago, some of the West Coast banks is this specific to one or two individual banks, or is this indicative of maybe some risk in the U.S. banking system? For that, we turn to Herman Chan. He covers the regional banks for Bloomberg Intelligence. He joins us here in our Bloomberg Interactive Broker Studio. So Herman, tell us, just summarize for us what happened at NYCB and what do you think is going to happen going forward for this bank?
So there's two things. One is our idiosyncratic factors, and one it's the overall risk in commercial real estate. The idiosyncratic factor is New York Community cleared the $100 billion asset threshold with the acquisition of Signature Banks that was facilitated by the FDIC last year. That ushers in higher capital and liquidity requirements, and they're trying to digest that. The second is that they cut their dividend to be able to increase their capital and increase their reserves because of some issues on the credit quality side, some losses in multifamily commercial real estate, and also in office. All
right, so for our listeners and viewers out there, nationwide, worldwide, does the U.S. have a regional bank problem?
The United States does not have a regional bank problem. It has a burgeoning potential problem in losses in commercial real estate, specifically office. And if you want to throw in multifamily, rent-regulated multifamily, it's a niche business in New York City. That's not going to be a issue across the industry. We'll see losses percolate in 2024 and throughout the next few years. But it's going to be a longer term issue.
How many more NYCBs are there? If we, as a general number, there's 4,000 banks. I don't need a number plus or minus 10. But are you feeling very William Isaac, S&L crisis, Robert McTeer of the 80s, or the complete disaster of the REITs in the 70s, or is this really hyper selective?
It's going to be selective going forward. And it has been, right? So the banks that failed were very focused on certain businesses that really didn't pan out when rates went higher, and now we're facing the similar issues with rates where they are elevated. It's tougher for these commercial real estate lenders to and their borrowers to refinance, and it's creating asset quality issues. And it's going to be banks that have an intense focus on commercial real estate, and that's going to be a small subset of the overall banking system.
And because Tom and I were talking about this, and we follow the news flow on this very carefully, which is when we see some of these big pieces of real estate change hands now, it's 50 cents on the dollar.
Right.
And it's all over the country. It's not just San Francisco or New York. It's everywhere. But I guess what I'm asking you is, what percentage of that type of real estate is part of the portfolio of the regional banks out there in the U.S.? Is it a big piece, small piece?
It's a fairly small piece. We're talking about, when we say 50 cents on the dollar, it's like those B and C class properties in central business districts that aren't getting a lot of occupancy. And that's not like typically where the regional banks play. They're in like medical offices where the operator is also in the office.
So the headline story here, when I hear bankers tell me things will be fine, or even someone as cynical as you, the heart of the matter is we're looking at them like they own every office tower out there.
Right.
And they don't.
They don't. And even if they do, you can go back to their underwriting, right, where their loan to value is about 55 to 60%.
Okay, so who takes the loss? Cut to the chase. There's a building out there. It's down 40%. It's going to be the headline in Cranes 2 days from now. Who takes that loss, Herman Chan?
The loss is going to be on the owner of the building predominantly, and the banks will take maybe some sliver, but it's going to be, the losses will be prevailing in areas like commercial banks. It's going to be in commercial real estate, CMBS, REITs, insurance companies. The entire financial system will face some sort of loss.
But Tom, it just feels like one of those markets where the smart money is going to come in soon. And I don't know who that is. Is it private equity? Is it just some smart real estate money? Is it the Rudin family? And they're going to start buying this stuff at 50 cents on the dollar. And we're going to have this story 5 or 10 years from now. Wow, what a time it was.
I do agree with that. But then here's the next question, Herman Chan. What I see, and I'm reading Cranes voraciously just to get the gossip and all that. I don't know anything about this. The foreign money is like a drug. I mean, they just show up in New York. Are they going to show up in Topeka?
I don't think they're going to show up the foreign money has to be in large, metro cities. So it's going to be in New York, Miami.
Are they buying LA with a train wreck in Central District LA?
That remains to be seen. Maybe if valuations have become really, really attractive, but we haven't really seen that at this juncture.
Pebble Beach? You were out in the eighth hole, and the Japanese bought.
There was a time when I first started playing Pebble Beach 30 years ago that every time I went out and played, which was probably 2 or 3 times a year, it was my foursome was all Japanese players because the Japan economy was so strong, the yen was so strong, it was close by, they owned it. You don't see that anymore. But again, the foreign buyers have been in the big metro markets. What are the banks saying about, will they underwrite commercial real estate today? Are they making loans? Are they refinancing? How's it typically happening? Because if I have to go refinance a real estate loan in Topeka, I got to pay a lot more interest rate.
Yeah, you're going to have to pay a lot more interest rate. What the banks are doing is trying to make sure that the existing borrower can repay and maybe inject some equity into it because the value of that real estate's not what it was 2, 3, 4, 5 years ago.
Thomas showed question over at Keith Briette and Woods. Are we going to see M&A? What are we going to do here? I mean, come on, Herman. It's got to be mating season, right?
It's got to be at this point. You see all these banks, and especially the banks that are wobbling, and then any other management team is going to be a bit shaken with what happened. So I think bigger is better, and need for scale is something that I think the industry needs to consolidate and create.
The value add, go to the Bloomberg terminal and look at Bloomberg Intelligence. Herman Chan, C-H-A-N. Herman Chan is just absolutely encyclopedic on the regional banks, not so much the hot air, the emotion of it, but the actual mathiness of where we're going to be in. Paul Sweeney and Tom Keene. And what we're going to do now for Global Wall Street is we're going to get wonky. We're going to edge on the edge of Imperial College in London, NYU Courant, in a small shop on the rivers of Boston, the Charles River of Boston. That would be the Massachusetts Institute of Technology. And that can only mean Katy Kaminsky. Katy Kaminsky joins us with Andrew Lowe's AlphaSimplex. Yep. Folks, this is going to be a little bit of jargon-laced, but it's going to give you a window into how the animals in the derivative space think. Katy, I have up in front of me the Magnificent Seven, and I've got a 5-trend quant log chart up. I have the Magnificent Seven on trend with log convexity.
Oh boy.
I've got room to run. I'm up only at 2 standard deviations up among those 7 stocks, and maybe there's an argument about is Tesla in it or though. Can you do trend analysis on this historic moment, this Magnificent Seven?
Well, I mean, I think if you look at the Magnificent Seven, they have been the ballast for U.S. markets, and they have driven a divergence trade for the U.S. It's put the U.S. in a much better position. But as we know, the trend can keep going longer than you think it can. And that's what we continue to see, is that there's still continued strength in that trend, despite some critics.
Is that trend linked, and I'm going to go over to the fundamental world away from AlphaSimplex, which is this new belief in an annuitization. And frankly, folks, I'm talking the Bloomberg book here. This is what we do with the Bloomberg terminal. It's been a real gift to us over 30 years plus. But the annuitization of free cash flow, the annuitization of that hunk of money at the EBITDA line, does that fold over into your technical analysis as a force, an inertial force to a higher priced Magnificent Seven?
Well, I mean, I think, as you said, I mean, we're much more of a technical trader, and at the end, the fundamentals become clear. But what you've really seen is resilience there in prices for those tech names, and there doesn't seem to be any indication that that's abating. And the other thing that's interesting to me is that, if you look at where we are, even with higher rates, those type of companies should be more duration sensitive, and they've wavered the storm. So perhaps it's sort of the value in the future is more technology than what we're used to thinking about for value companies.
Hey, Katy, I know you guys at AlphaSimplex are, as you mentioned, technical focused. You're also global. Where's the global relative value? I actually, for the first time in 20 or 25 years, I hear people talking about Japan here. So I'm wondering, where is the relative value out there?
So the interesting thing that we have seen, and this is something that we can talk about this in a minute because I'm always nervous. You've seen very strong signals in the US and Japan, and you've seen very weak signals in China. In fact, China's been down for 2 years and almost 50% if you look at the A50. So that to me is something very interesting, that this huge divergence across performance, albeit that, we just talked about the tech names really being a leader for the US. But the question for that all comes back to inflation too, is if China has been down so much, they're a huge driver of demand for raw commodities and the commodity sector. Is that the missing sort of key component that has driven inflation down in the short term? Is that China is a big player and they've definitely been in the bunker.
They have been, and I'm not sure if it's technical or just the fundamentals of, is China even investable here? So I'm guessing your technical signals are flashing pretty green for China, but then how do you overlay, I guess, the fundamental just kind of country risk factor?
Oh, well, I think that's definitely an issue. I think what we're more concerned about is there a stimulus package? Is there a way out of that trend, which causes increased demand for commodities? Because we've kind of like forgotten about China. If they get back in the game, things change. I mean, if they increase their demand for raw commodities, you'll see that change.
But the heart of the matter here, Katy, is the stochastic view of catching the knife in the dark, and right now China's the knife coming down, down, down. What you're saying and Andrew Lowe's saying is you got to find trend. When China turns, and let's be optimistic and believe a society has to, when China turns, how do you know when to get on board a nascent China bull market?
So we're not seeing, we're starting to see some indications this week. People have been looking for a bottom in that market for some time now. But we need to see confirmation in the data, and we haven't seen that yet.
Right.
I think people are nervous right now because it is the holiday season, and how far that trend has really gone a long way.
You got some parchment from MIT. She did like double E and a bunch of other fancy degrees.
I thought about MIT.
It's off your remit, Katy, but I want to go all Eric Brynjolfsson on you. Can we do that? Is it okay,
Sure.
Katy, if I go Eric Brynjolfsson on you? What is this AI stuff? I get the idea ChatGPT works, Microsoft Copilot, Azure, blah, blah, blah. But what portion, Katy Kaminsky, of AI is hot air?
So AI is great for solving some simple problems and to deal with data and to analyze lots of information in an efficient way. We see it in our space more for things like execution, just dealing with very complex, complicated data sets and distilling that down into information. I think the idea that you're going to let AI trade your money is still very far away, at least from my personal view as well. But it is a tool to help us to analyze more things in less time and automate a lot of things that, could make our focus onto something else. So that's kind of how I see it. It is the future, but it has to be taken with trust and with understandability.
Yeah, it seems like one of the questions I asked the tech analysts, Katy, when we had them on, is how much of is AI capital spending or just development of AI? How much is that just taking? Is it new money? Is it new spending on AI, or is it just moving it from some other IT budgets and things like that? So from your perspective, just from the academics, is AI really new, or is it just taking the next step in making everything more techy?
AI is definitely not new. It's just about, can we find new applications for it? And are there ways, and you'll see this in the financial sector, it's interesting. All the large firms have really invested in AI because they know they need to be there, and they're still trying to sort out, okay, how do we use it? And what are the applications? So I think it's the next phase, and there's the adoption,
Katy,
but the application is still unclear.
Katy, one final question here. My quote of the year last year was a guy named Taleb. He's pretty good in derivatives. And Nassim Taleb said the gravity's returned. And that's really what's going on here. We finally have interest rates up. We've got a risk-free rate. We've got a legitimate, calculable Sharpe ratio. You know all the mumbo jumbo as well. Can there be too much gravity? Can there be too much like a higher real rate that gums up our investment horizon?
So I think that's a great point. I mean, I think for us, everybody's sitting around hoping for lower rates because who doesn't like that? But the truth is that's not the normal equilibrium. And I think what you're seeing as well is, I mean, do you think policy is restrictive now? I don't think so.
What, she interviewing me?
Yeah.
Did you see, Lisa Mateo, did you see how Kaminski did that? Who's running this program? Do I think things are restrictive? There's a lot of people out there going, come on, Tom, answer. Oh, look. Mike from Bermuda just emailed and said, don't answer that question. Katy Kaminsky, go away. You're restrictive, but also accommodative as well. Katherine Kaminsky, folks, with AlphaSimplex. Can't say enough about their work. We're going to stop the show right now and take a broader view. Kenneth Leon is a CFRA research, usually joins us on the big bank days. He does not cover the regional banks. And there's all sorts of legal issues. You don't talk about what you don't cover. But as research director for CFRA, we're going to take a broader view of the NYCB debacle and not speak to him about the individual securities. Ken, what are the government doing right now? I mean, this is a debacle, commercial real estate, a debacle, this singular bank, maybe there'll be others like them. What are government institutions like the Fed, institutions in Washington, and in this case, Albany, what are they doing right now?
Great to be with you, Tom. And what's going on in Washington is we had comments this week from the head of the OCC that M&A for the banks is going to be tougher. And also, there's going to be significant capital build for most of the banks. And what this means, I think, for investors is that we're not going to see a systemic risk, a bank failure of the industry, but we're going to see kind of situations as we did with New York Community Bank. So I think it just has to be put in the right placement, that this is not going back to March 2023. But it's something that gets the attention of the market.
If the industry struggles with this, gets the attention of the market, and they're smaller institutions, does that lead to more consolidation of the industry?
There is, and there are still 4,000 banks in the United States. Regularly, Tom, we speak about the big six that dominate and are gaining market share and expanding across the U.S. So again, it's what's happening with really small banks that might have founders that want to sell because there's no succession. In some instances, you're going to see these elevated risks for real estate for those that have a high percentage of their loan book related to some troubled real estate.
And Ken, I guess what a lot of investors are trying to get a handle of, and it was literally a year ago that we had some problems with some of the regional banks on the West Coast, and now we've got the New York Community Bank. So what are the good folks at CFRA? Are you concerned about the status of just kind of the regional banking system in general? Or again, can we chalk this up to some more just specific idiosyncratic issues?
It's a good question. If you go back in time over decades, a bank analyst would say by region, you might have more exposure to Texas banks if the energy industry was failing. In this situation today, we go through really rigorous bank metrics and to see who is under reserved, who has not had a good balance in terms of diversifying their loans. And in situations of, in this case, commercial real estate, it's going to be those banks with assets perhaps of 50 billion to 100 billion, it could be at risk.
Ken Leon with his director of research at CFRA, previously scheduled to be on Disney.
Oh, they report earnings after the close.
Joining us now, Ken Leon, bank expert on the don't bank on Disney, I guess is it, or the other media stocks. Paul, why don't you talk to Ken Leon about the debacle known as Disney?
Ken, so we've got Disney after the close, and there's a million issues to discuss, but I guess the latest one is just kind of what we heard the announcement today that Disney's going to hook up with Warner Brothers Discovery and Fox to create a standing sports streaming offering. I didn't see that coming. What do you think's going on there?
Good for them. So, I think when you look at Disney, Warner Brothers Discovery, and also Fox, they basically were victims to the NFL and other major sports leagues of spending billions of dollars. It still continues, but putting them all together and putting them in a package for streaming, this gives them an opportunity to have a little bit more pricing power to defend. And also it puts at risk those that are not in this troika, which would be Comcast with Peacock. We saw what happened with viewers in Fumed when the Miami game was not on NBC, but on Peacock. So, I think there's a lot of moving parts here, but essentially what we're seeing is an opportunity to really get more rational pricing. But Disney's got more to say later today after the close, because they're still looking for an equity investor into ESPN besides this partnership with Fox and Warner Brothers Discovery. And that's a de-risking by Iger about ESPN, because you're falling off the cliff in terms of cable viewers.
Paul, in your head, what's your percentage of investment in ESPN by a dreaded outsider? Is it like a minority 5-10%, or is it bigger?
I think it'd be bigger. I think, particularly if it's a big entity like the NFL, I think it would not be a controlling stake, but it would be a large stake so that they would have multiple seats at the table. And Ken, I guess, what do you think is the big, what do you think Bob Iger needs to do here this afternoon on this conference call? Because the stock, investors used to love this name. I just get the sense they have no idea what to do with this story.
Well, they're beginning to prune assets. They may have something to say in India, which was never, it was an eater of assets, but not profitable. So selling that business. And as Tom knows, you got James Gorman now on the board of Disney. So looking for businesses that have durable revenues and really have the magic of Disney will be the theme parks and renewing film. So Ken, I think that's a big change.
Ken, what do you do? You're a grizzled pro. I was going back looking at the REIT debacle of the 70s. All good things end. Trees don't grow to the sky. Rumor. Thank you, Goldman Sachs, for that quote, the Weinberg family. Ken Leon, help me here. What do you do with the Magnificent Seven?
So for CFRA, what we see, is valuations that still seem reasonable for most. It becomes challenging for investors when you look at the overall stock market because of the significant weighting that these stocks have. I don't believe it's like really in my career when we had the tech boom bust, because these are businesses that are throwing off enormous cash flow and are also innovating to drive organic revenue growth. It's a little bit different, but I never like to say this time is different than the others. Whether it's the Nifty 50 back way in time. So I think investors have to be prudent. Diversification does make sense, but it's an outsized weighting of the entire S&P 500 comes from the Magnificent Seven. But I'll give you one more, Tom. In the financial sector, which, we talked about the banks being so challenging, there's about 12 stocks that are 70% of the financial sector. So if you're a fund manager and you say, I want to be overweight the financial sector, as CFRA does, it really gets to names like Berkshire Hathaway, American Express, MasterCard, Visa, JP Morgan Chase, and others. So it's a big difference. So I think that's the conversation. What is the big constituents of the market, in Act 7, or in any given sector? And that's how CFRA thinks about our weightings.
You can't got to leave it there. Thank you so much. Ken Leon with us. Today's front page headlines. We had like 18 ideas in the newspapers today. Lisa, what'd you top it with?
We've been going crazy this morning, I know. All right, so this first one stood out to me. This is from the New York Times. There's been a rise in the use of psychedelic mushrooms. This is becoming popular. There was a study that says that law enforcement, they're confiscating more of it. It's illegal, right, under federal law, but it's gaining popularity because people are using it as therapy. They're saying that it may be useful in treating depression, so a lot more people are taking it. But experts are saying that hype, it's really moving faster than the science. There's some states that are moving to legalize it. You have Oregon, Colorado. It's legal there for therapy.
That makes sense, those
yeah.
states.
But the New York Times actually had, a Wall Street Journal had an article about it, how more high-powered working moms are using these magic mushrooms.
Why? Just to chill?
Take the edge off a little. You know,
So this
they're
is more than
stressed
just
out.
That's why you listen to
Taking the
Bloomberg
gummies.
surveillance. But
Yeah.
are we back to Timothy Leary in the early 60s? I mean,
It's coming back.
Boy, I thought gummies were for
No, to
folks.
see,
Okay, we're
apparently,
going beyond that. All right.
But because the gummies are legal. See, this
Yes.
isn't legal.
can
so
you
this
take
is
too much? That would be my.
Ooh,
I'm
that's a
really
good question.
ignorant. I mean, okay, full disclosure, I'm not really ignorant on this, but long ago and far away, I remember frat brothers that took too much. Can you take too much?
I bet.
The psychedelic mushroom? I'm not sure. I mean, I'm sure it'll definitely affect you, most definitely.
Oh, someone in the control room said
Somebody-
yes.
yes.
You know, we don't know who
voice
that
of
was, but
The voice in the dark.
you guys are killing it in there today. It's like a Swiss watch in the control room. Next.
All right. If you're looking to get in shape in the new year, the Wall Street Journal is saying,
looking at me.
take a break from drinking.
Pass.
Yeah, the gym said you already got a pass. They're saying the dry January, it helped out a lot of people, but it depends on how much and how often you drink. If you just keep it to, let's say, the weekends, it might be a little bit better. Full disclosure, I used to, have a cocktail or two every night during the week, every day, with dinner, a glass of wine. And when I cut that back and I left it to just like maybe a Friday happy hour or Saturday, you see the difference.
Really?
I'm telling you.
All right,
I saw a difference.
I'll take
from
your
it.
word for it.
But they say there are health benefits. You sleep a little bit better. You get better sleep. You're a little bit more rested. People tend to lose a little bit of weight when they do that. But,
Win-win.
it's up to everyone. Not everyone is, up for it.
Is this like the lecture? We're getting them.
She's looking at you and I back and forth.
Peering across the room.
Mushrooms first, and
So I'm going to give up
the
my
beverage
Tito's
of my
cocktail
choice.
for shrooms? Is that what I'm doing?
There you go.
Save us. What's next?
Okay, we've been talking a lot about this. The whole quote-unquote Hulu of sports, right?
Oh,
You heard
okay,
Michael
good,
Barr talk about it, right? Walt Disney's, ESPN, Fox, Warner Brothers Discovery, they're all launching this streaming sports service in the fall, of course, right at the start of the NFL college football season, just happens to be. But, you think about it. You got ESPN's Monday Night Football, Fox's Sunday NFL game, March Madness college basketball that's carried on Warner Brothers. But there's some people missing out of this picture, no, Paul?
CBS, they've got a big NFL package. NBC has the Sunday night package. So I want to see the backstory, which we'll get from somebody, how this came together, how these, these three
Desperation?
Desperation, I think is the call there.
Okay, so let's review this. As Sweeney's like world class on this. In the old days, we had a $100 cable bill.
Yep.
Without question, the biggest hunk of that was ESPN.
Yep.
Right.
Yep.
So with that said, if we're pricing $100 million streaming things at $9.99 a month, where do you think this thing will price in?
Boy, it's not going to be $10 or $11, I don't think, like we're all used to for our Hulus and our...
So we're going out and spending 20-something or even
more.
30-something?
Yep.
More?
I think so. ESPN alone is $10. So
So we're popping another $300. You're asking $300 a year.
Well, I think what happens, since all the stuff we pay for otherwise, like Max, for example, I think if I pay for Max, I might get this new thing. Like, we don't know the name of this new product.
We don't know the name.
We don't know the
price.
pricing. We don't know exactly all those things. I think if I pay for Max or I pay for something else, I'll get grandfathered in. I don't know. But all I know is I'm not paying any more. So if they want me to pay for this standalone thing, I'm cutting out 2 or 3 other of my streaming
Right,
services.
or do you cut the cable? That's the whole
right,
thing.
that's
That's the
right,
question.
yeah.
Comcast, what is it? And what is Comcast, NBC, Paramount Global, CBS? What do they think about this? They're kind of a little bit absent from
it's
the
funny.
picture.
Comcast, we'll call it today just generically a cable company. They haven't thought of themselves as a cable company for 5 or 6 or 7 years. They consider themselves a broadband company. We deliver high capacity internet connection to your home. Oh, yes, and by the way, we also have 500 channels of TV services.
Go there, because I saw this in the zeitgeist here in the last 24 hours. I'm going to pick on Charter just because I'm guessing that's where I saw it. Charter or the others, they really, really want to deliver your internet service to your house.
Yeah.
Is the stuff Lisa's talking about, Hulu Sports and the rest, is that now just noise?
It's become increasingly just noise for the cable companies because they make, while they don't like to lose you as a video subscriber, they don't care that much because they make so much more money profit on you as a broadband customer than they do as a video customer. So they're willing to trade a little bit at the margin. I'll trade away some video customers as long as I can keep adding broadband customers.
This is the Bloomberg Surveillance Podcast, bringing you the best in economics, finance, investment, and international relations. You can also watch the show live on YouTube. Visit the Bloomberg Podcast channel on YouTube to see the show weekday mornings from 7 to 10 a.m. Eastern from our global headquarters in New York City. Subscribe to the podcast on Apple, Spotify, or anywhere else you listen, and always on Bloomberg Radio, the Bloomberg Terminal, and the Bloomberg Business app.